Thank you, Aisha.
Let me also welcome on board Pankaj Pandey then and find out what his market view is right now. Pankaj, two important earnings today, both Tech Mahindra as well as Axis Bank. And let me start off with Axis Bank. Given what we've heard from a Kotak, from an ICICI Bank, to an HDFC Bank, of course, and IndusInd, what is your anticipation of what Axis Bank could deliver?
Hi, good morning. Thanks for having me. You see, on Axis Bank, from a valuation perspective, valuation looks okay at about 1.8 times FY25 basis. I think overall, our sense is that we would expect some kind of an NIM to sort of decline. And if it remains in the range of, say, 10 to 15 odd bips, then I think I would consider the number to be sort of positive. I think any extra or more than that decline, I think, would be sort of negative. But I think our overall sense is that one needs to watch out for the NIM trajectory for the bank. And the rest, I think most of the other variables are looking to sort of or are expected to be okay. On the Tech Mahindra, given the fact that we have seen most of your tier one IT names sort of disappointing, I think except for order booking, none of the variables have actually sort of been good. And Tech Mahindra is already sort of undergoing transformation. They had previously, they were high on in terms of M&A-led growth. I think that probably we would expect probably a shift from that side. And that would again mean that you would continue to see numbers as well as growth below subpar. And I really do not think that near term we would expect an outperformance on Tech Mahindra, despite the fact that this is one of the cheapest stocks within the tier one names. I think one needs to watch out for what is the sort of a future plan of action they, given the fact that they've got a new CEO. So I think that holds the key rather than the current quarter numbers.
Pankaj, FIs were buyers on Monday, DIs were buyers on Monday. Mid caps were down, small cap stocks decimated. So the question what we are asking everybody is, who was selling? Was Pankaj Pandey selling? Who was selling? Becha kaun?
So Nikunj, I think what one needs to see is that whenever we see softness in the market, the intensity of fall is definitely a lot more higher in, say for example, small caps. I mean, historically, if you look at last 10, 15 years, typically in a large cap, every year you will see 10 to 12% kind of a correction. For mid caps, that is somewhere in the range of, say, 15 odd percent. And for small cap, you see a correction of nearly 20 odd percent on an average basis, with the range being 10 to 35 odd percent. I'm excluding the 2008 odd year. So from that perspective, whenever we see softness, we will definitely see mid caps and small caps sort of correcting. But we continue to like small caps for a number of reasons. One, I think we have seen the maximum upgrade in earnings for small caps in good double digits since the beginning of this year. Then our sense is that the domestic macros are good for the next 6, 7 odd years, which is a very fertile ground for small caps to sort of do well. And the other sense is that when you look at, say, large caps, it's a very narrow space of 100 stocks. Mid cap, again, very narrow space of about 150 odd stocks. But when you sort of look at small caps, the entire rest of the market is small caps. So they were slightly sort of overbought, which is why we've seen that kind of a correction. But our sense is that if domestic macros are holding up good, we would continue to sort of prefer the small caps. And I think in large caps, valuation look attractive. So some of the large caps are also sort of okay. I think mid caps could be a challenge.
Okay. You know, the one space that is in focus is going to be agrochemical stocks. After the American major FMC has actually cut its guidance once again, citing a challenging environment, expecting the pressure to persist in the near to medium term. In fact, Somit is here with details from that note.
Well, FMC has yet again given a revenue warning. Now, this is for the second consecutive quarter where they have downgraded their revenue and adjusted EBITDA guidance for 2023. Now, for in the previous quarter, they had downgraded by around 14%. There was a revenue cut, and around 12% cut was seen on the adjusted EBITDA front. And this time, they have cut their revenue by around 13%, while the adjusted EBITDA has been cut by around 26% for the calendar year 2023. Moreover, the management has also said that they are seeing significant pressure when it comes to agrochemicals in the near to medium term, and they're expecting the destocking conditions to persist even in the next calendar year, that is 2024. Now, they're observed that the channel destocking is continuing in all regions expect, and they're also saying that the magnitude of destocking that they're seeing in Brazil has been much greater than what they were anticipating earlier. Now, they're also saying that the application of the products are pretty much stable from the growers, but it is the destocking that is going to impact them even in the next calendar year, that is 2024. And they're also initiating immediate restructuring process for operations in Brazil because they need to contain their cost, and because of higher cost, in fact, if you're seeing that adjusted EBITDA has been downgraded by 26%, and now the company is trying to contain this cost going forward. Now, because of this lower revenue guidance, and given the fact that they're also expecting lower revenue for 2024, the companies that would get impacted in the Indian market are, firstly, it's UPIL, because it's also an agrochemical producer and exporter. Apart from that, there are a host of chemical companies that would remain in focus, like SRF, Aztec Life, Anupam Rasayan, Jubilant Ingrevia, and Navin Fluorine. Now, all these companies are exposed to agrochemical cycle as they supply to leading agrochemical companies like FMC, Syngenta, Adama, Bayer, Corteva, and BASF. And all these companies could also see significant pressure in their earnings going forward.
All right. Pankaj, 3 stocks which you are telling your clients that don't worry about what happened on Monday, don't look at valuations, but just buy them because 2-3 years from now, they could be up 20 to 50%.
So, Nikunj, what we have been liking is, say, for example, within the, say, small cap spaces, some of the cement companies plus some of the infra names. So, for example, what we are liking is JK Lakshmi Cement, where target price is 840. We have been liking, say, Sagar Cement, where target price is 305. Then we have been liking some of the infra names because our sense is that in the second half, you'll see more of order inflows coming up because up till now, first half has been softer, especially the Q2. So we like the entire lot of, say, KNR construction, where target price is 340. We like PNC Infratech, which also looks attractive to us with a target price of 460. So I think these are some of the names which we have been sort of liking because we haven't seen much of a price performance. And on top of it, our sense is that you will see better set of numbers in terms of top line growth, plus no major challenges on the margin front, and valuation being okay for most of them.
Well, the GIFT Nifty is indicating that we could be in for 46 points higher, which means this is the implied value. And Kunal, just stay with me here. If I say implied value, what the implied value is saying that when market shut on Monday, Tuesday GIFT Nifty was trading, Wednesday GIFT Nifty is trading, but if implied volume number is anything to go by, looks like at 9:15 when markets will open, it should be up rather than down, right?
Yes, it should be up rather than down.
Let's look at the 10-year paper. On Friday, it had crossed 5%, but today it is below 5%. Crude, it was above $90, 91 and a half. But as we walk into trade this morning, that also is in a measurable manner. So the cues have not deteriorated. You've not seen anything which could be called as a amplification of global bad news or deterioration of global setup. Global cues are measurable. And for me, I think we'll put that Twitter quote out of Bill Ackman, not a Twitter quote, but a tweet rather. You still call it tweet, right?
Yeah.
I mean,
You don't call it X.
No, I don't know. See, retweet has become post. So I don't know if the terminology is changed or not. But it's called tweet, right? Okay, tweet. Bill Ackman's tweet, we'll put it out, where he's covered his short positions. Why am I bringing it out? Because, I mean, there you go. The economy is slowing faster than the recent data suggests. It's Bill Ackman. There is too much of risk in the world to remain short bonds at the current long-term rates. What is Bill Ackman saying? That American economy is slowing down and we are covering our short positions. And he was very vocal about it, that he was short the long-term bonds, which is the 30-year paper. Now this is, I mean, he's been known for his notoriously short positions earlier this year, during COVID, and a couple of years ago in some of the pharma names. He understands the short business very, very well. I mean, he's like Soros. He understands the short business very well. So if a short seller is covering the short positions in the bond market, that just makes you wonder that have bond yields really peaked out now. Pankaj, how much of narrative change could that be?
So I think in US, every alternate day you hear something different coming out. I think you have Fed policy meeting lined up on 1st of November. While you're continuously seeing data ups and downs, but I think global issues are still sort of lingering too much. And I don't see a definitive trend where things have started to sort of cool off. So from that perspective, global led volatility, be it driven by higher crude oil prices or be driven by 10-year or 2-year plus, say, even 30-year inching up or going beyond 5%, I think that is going to remain there and probably we'll have to live with it some period of time because this time Fed is not expected to hike rates. Even the probability of hiking rates in December is lower. But a lot depends on how the Fed sees, because when you look at from an inflation perspective, 3.7, you're on a positive real rate in US, but that is still the inflation is still intended or still higher than what they've been sort of looking at in terms of 2% inflation as a norm. So I think globally, very difficult to draw comfort as of now, even with the recent data flows or crude sort of coming down below $90. I think things can change. Things are changing on a daily basis.
Yeah, they are. And Kunal, much like our markets, it's the global markets which are more sensitive to the way the yield actually pans out. You've been studying the charts of the Dow, right? I mean, overnight, of course, there's been a bounce coming in, almost a 200-point move. There are a lot of critical earnings as well coming in. The markets have been reacting to Microsoft as well as Alphabet reports. But tell me, what's the chart for the US equity markets and in specific Dow looking like?
So Dow, in fact, from the June-July highs, when the Dow was, I think, 36,000, 35,500 to be precise, I think from there, the index has been making a pattern of lower highs and lower lows. Now, the only good part is that so far in the last 1 week of correction for Dow Jones, we've not managed to make a new swing low. And I think that swing low for the Dow was around 32,800, 850 mark. So we are just slightly above those levels. There is a bounce which has happened on the Dow yesterday overnight, so that could probably mean that maybe for the near term we may not have made a new low for the index. And I think on the other hand, if we even manage to surpass about the first major previous high, which is 34,000 mark for Dow Jones, we could be looking at this 4-month, 5-month downtrend reversing for Dow. So we are at a very crucial stage, a sort of a make or break level for Dow Jones. If we don't break below the 32,800 mark on the Dow, then I believe there is a strong chance that we may get into a breakout. And if we break above the 34,000 mark, we've probably ended this 5 months of downtrend. We could be looking at a serious uptrend for the indices.
45 points higher. I won't go back to that fascinating number. I'm just obsessed with that number, maybe. But because on Friday, when Monday, I beg your pardon, on Monday when markets fell, it appeared that we could be in for a big sell number by institutional investors. But that's not true. For Monday, both FI and FNO, DI and cash, everything put together, the number was not bad at all. So 23rd October, 252 crore plus. 456 crore was the number on Friday. So it's not like FIs are not really behaving themselves well. I mean, they've not been rampant sellers for sure. And markets, I guess, are still nervous about the setup. The FI, FNO short, it's more short than long. Naresh, 1 day of selling and chins are down. That's my only submission here, that the market sentiment was nervous and has remained nervous, and it has now become fragile after 1 day of selling.
So see, the extent of selling in the mid cap and small cap is what really scares off, and the fact that we are not very far away from the all-time highs in the mid cap small cap index after this move. Also, we are still 3-5% away from an all-time high. So we have not corrected like the world markets have corrected. So if you look at a Russell 2000 in the US, it's down below the March lows. At the same time, our small cap index is up 30 to 35% from the March lows. So that's the difference, and that's why there is a lot of fear given the global market conditions have not been great. And on the Nifty for the last say almost 4 months, we've been around 19,250 at least at some point of time. So we've just been there. We've not seen a correction in a major way or a rally in the last 4 months. The hopes come up at 20,000, 20,200 of a momentum to continue at 19,200. The hopes dwindle, but we are right in this band. So overall, the case is because the small caps and the mid caps have had a good rally from March lows, almost 30 to 40%. Stocks gone up a lot. There is bound to be some fear, and we see aggravated selling on a single day. We saw this happen on September, wherein we saw many stocks fall 10-15%. But we normalized over the next few weeks. It's just that we need to be more careful at current levels because this is the second shake-off move on a single day.
A lot of other stocks which are going to mean focus, and Ashisha, or rather Somit, was just highlighting as to how FMC yet again has slashed their 2023 guidance. So this is not going to spell good news for already under pressure, the likes of a UPL, SRF, the entire chemical space largely. Also, SBI Cards, the new card additions was the lowest amongst all private as well as PSU players. So that's going to be another stock that we're going to be looking out for. Mahindra Logistics, and quite disastrous numbers there. They've reported a net loss of about 15.5 crore rupees versus a profit of 12 odd crore rupees on a year-on-year basis. So that is one stock as well that we're going to be looking out for in trade today. Besides that, of course, Delta Corp, look out for this one. You've been seeing some dead cat bounces on the stock of late, almost a week of gains actually on Delta Corp. The High Court has now directed authorities not to pass any final order on the show cause notice without prior permission of the court. So that's one stock which is in focus. There's Ugro Capital as well, wherein MK has initiated a buy with a target price of 425 on this one. Torrent Pharma, we just flagged off earlier in the day that Jefferies is maintaining a hold. They've upped the target price also to now 2040 from the earlier 1950 thereabouts. And, the note very categorically mentions that Torrent Pharma is not going to go out for an acquisition which is over 3x of the cash on their books in terms of size. And that sort of puts all the speculation to rest with regards to the Cipla promoter family stake. That said, PNB Housing Finance also has come out with its numbers, and a decent one at that. The PAT is coming at 383 crore rupees, and that's an uptick of about 46% on a year-on-year basis. So these are a bunch of stocks that we're going to be looking out for. But Naresh, I don't know how closely you've been tracking Delta Corp, because that surely has been giving off some amount of bounces. Given how oversold the stock has been, you think there's less to lose?
So over the last, say, 6 to 8 months, the developments have made people lose faith in the stock. And we've seen this over the last 10, 12 years. It's been a major disappointment. Every time the stock has started to rally, there is some or the other issue. And in the last 6 months, we've seen 2-3 big gap downs. So we saw a big gap down from 250 levels, you went to 190. Then again, we've seen say we were at 170, 180, the stock fell to 140. And the stock price is the same where it was back in 2015, 16. So right now it is oversold, but till the time there is no trigger event, wherein a positive event, one cannot bet on it because there could be a long time where the stock goes nowhere. So it's not that the stock is not oversold, but the fact is after a 20% uptick on some positive event, one would be better off buying rather than now.
Okay, meantime, you've also got some of the stocks like Nestle, which are on the brokerage radar. You've got Macquarie, which has maintained a neutral, and they've got a target price at about 22,700 on that one. We'll be discussing some of those top brokerage notes, but that's the pre-open ticks coming on your screen. And for now, it's absolutely flat, so holding out around the 19,280 mark, and when it comes to the Sensex as well, up about 50 to 60 points. But it'll be more critical today to watch out for what happens with the broader markets given the kind of meltdown we witnessed Monday. Let's find out those mid-cap strategies then from our chartists. And Kunal, what's popping up on your radar today?
So I'll suggest a buy on Voltas. That's a stock which showed good promise on Monday. The stock managed to bounce back from its 50-day moving average as well as a crucial support in terms of the levels of 800. So keeping 800 as a stop loss would suggest a buy with a target of 860.
Right, Naresh, what's on your mid-cap list?
So that would be a buy on Kaveri Seed. The stock has been showing good strength over the last few weeks. The breakout done above 580, 600, made a move towards 680 odd levels. Last 3-4 sessions, the stock has been volatile, but the bias has been positive. Expecting this breakout to continue higher. Stop loss at 620, target price of 700.
Okay, there you have it. But it was just talking about, those fresh brokerage notes as well. And Pankaj, a note coming out on Nestle by Macquarie, talking about a little more clarity that's needed on near-term demand, their timelines for commissioning capex plans as well. What's been your key takeaway from the FMCG earnings? How have you looked at Nestle?
So I think overall FMCG earnings have been on sort of expected lines. We don't expect much of a magic to sort of happen in terms of growth rate. Valuations are quite rich for most of the players. I think this segment did entirely well when a lot of segments were sort of underperforming. And I think with growth being expected in high single digits to mid single digit, I don't sense that most of the FMCG names outperforming the market. So, which is why you would not see any active recommendation coming from us on this entire pack. I think they had done their job when nothing was working in the market. They did well, but I think our sense is going forward structurally, one should be underweight in FMCG as an entire pack.
Pankaj, great to have you on the show. Thanks as always for taking the time out and
Thank you so
joining
much.
in. Let's also tell you what else is happening.